Patrick Berry, and I'm a real estate appraiser. And our firm focuses on nothing but multifamily. And since 1983, we've appraised nothing but apartments. We just crossed over 6,000. And I'd say about 60% of our work is for banks, and about 40% is for estates. So think, gifting, divorce, death, even people who are doing their due diligence prior to a sale and want to get kind of a non-biased opinion. So that's what we do all day. We do 5+ units, Portland, Salem, Metro. So from there, I think I'll just jump into the presentation if that's good with you guys.
Yeah, that's perfect.
Okay. Yeah, so I appreciate the opportunity to come here tonight. I can take questions. I have the Q&A box open, so if they're relevant, I can try and address them at that time, or I can address them at the end of the meeting. So, this presentation was a bit of a challenge. We more or less have a template for a lot of these presentations. And it involves talking about a big picture economy, moving down to states, Portland Metro, getting into apartment fundamentals, moving on to values, and then some other trends. And we always like to talk, especially year end, we like to talk about year-over-year changes. And, at this point, referencing year-over-year job gains or absorption or vacancy rates, it's just not as relevant as it once was. So I'm not sure that the recent past is the best predictor of the future, at this point. But, to start the presentation, I pulled up something that we'd used it was actually March 4th of 2020. And at that point, we were discussing, solid national job growth, averaging about 175,000 jobs per month. January was particularly strong at 225,000. We had GDP in the 2 to 3% range. And then on February 28th, COVID kind of hit the national news. And the CDC came out with a statement saying it's not a matter of if it will hit the US, it's just a matter of when. And you can see, this was February 28th, and here they say public spaces could empty out as people stay home to avoid getting the virus and giving it to anybody else. And we discussed this during, a March 4th meeting for CCIM. And at that time, I felt that we were out there a little bit, that we were maybe going out on a limb, making a big deal of this, but we all know how this turned out. And, Mark Zandi, chief economist with Moody's, came out with a bold prediction 8 months prior to the election, saying that this could be a significant threat to Trump's reelection, and we all know how that turned out. So my presentation today, it's going to have a lot of good news and it's going to have some not so good news. But no matter what I cover today, up to this point in the cycle, apartments have fared far better than anyone thought. In interviews, I did a bunch of interviews, post-shutdown, and there was some panic and there was some doomsday predictions out there. And none of this has come to fruition. So even though there will be some items today that are not so positive, just keep in mind that we're in a far better place than anyone thought we would be right now. So in today's presentations, I want to cover indicators that I consider essential to apartments, employment, population growth, homeownership, interest rates, construction, then move on to some apartment fundamentals with the rents, income, vacancies, expenses, go on to some sale trends, and then a few political issues and some forecasts. My sources for this were the ULI emerging trends. I use a lot from the State of Oregon Economist, and then also CoStar. So the US currently sits at 6.7% unemployment. This is a very high number, but we've officially left that uncharted territory portion of the unemployment rate. We're down from a rate of close to 15%. In November, we added 245,000 jobs. This was a bit disappointing, but it likely reflects the current rate of infections and current shutdowns throughout the US. Q2, we dropped 33% in GDP. Q3, we were up 33%, which is obviously good. We're heading in the right direction. These are just wacky figures and they're tough to wrap your head around, but keep in mind that going down 33% from a baseline and then increasing 33% from that lower baseline, it doesn't get you back to where you started. So we're still down. We're hoping for a big Q4. If you look at employment, this is employment in Portland Metro. At the peak in February, we sat at 1.23 million jobs across metro area. In the weeks and months following February, we lost 163,000 jobs. And today we still are down 110,000 jobs from that peak. Gains have slowed. We're averaging about 7,100 jobs per month since June. We're hoping that picks up as we, get the vaccine and start getting people back to work. In Portland Metro, we sit at 6.9% unemployment, which is down from 14.3. Most counties, or all counties, are heading in the right direction, but Washington County is clearly a standout. They sit at 5.9% unemployment, while you have Multnomah County at 8.3%. So you hear a lot about this, and I'll talk about it today. We have this emerging divide in the recession between urban and suburban. Most recessions, you have smaller towns that'll trail the recovery. This information is a bit dated, but you can see, rural counties are down 5.7% in their employment. You look at small to medium-sized towns, and they're down 7.5. And then you look at Portland Metro, and we're still down 10.9. So, everybody's clearly performing, Portland MSA right now. Another big indicator I look at is population growth. For a host of reasons related to the pandemic and the economy slowing, population growth has slowed. Oregon peaked in 2016 and 2017 with between 40 and 60, or just over 60,000 new people in Oregon per year. We slowed down to about 40,000 in 2019. Previous forecasts had called for Oregon growing at about 40,000 into the future. Economists have changed that. They revised it down somewhere between 25 and 30,000 in the coming years. And this will be a theme that I hit on later. But, this next slide right here, this is the perfect illustration of why Portland Metro and Oregon, why they need to remain competitive in terms of quality of life and in terms of attracting business. This is the dark blue is migration, and the light blue is natural increase in population. You can see that if you go back to the 1990s, natural population growth was maybe 20 to 30% of our overall population growth. In recent years, it's been closer to maybe 10 to 15%. But by 2027, they forecast that all growth is going to be from migration, that we're actually going to have declining, we're going to have more deaths than births once we hit 2027. So in terms of Portland remaining competitive, both business and quality of life is absolutely essential moving forward. And these trends of slowing population growth, it's pretty common across most major metros right now. But I think that Portland has set itself up to have a strong recovery in the coming years. Since the Great Recession, Portland has seen a fundamental underlying shift in the underlying demographics. From 2005 to 2018, Portland jumped from number 28 highest median income to number 13. During that same time, we moved up to the 6th most educated city. And during those times when we were adding 60,000 people per year, we were adding people in what a lot of economists call their root-setting years. They were between 25 and 34. They came to Portland, they got their first real job, they rented the fancy apartments, hopefully they met a spouse, they got married, they bought a home, they have kids. And at that point, you really do have roots in Portland. And that means that you're likely going to stick around through your peak earning years, through your 50s. So while retirees are great, they don't provide much tax benefit. So economists love to see that younger group of people, move to Portland. So the next thing I want to cover is home ownership. I know you guys focus a lot on home ownership, both from the realty side, but home ownership can hurt apartments a lot. And this is the indicator that kind of makes me a little bit nervous. In the run-up in vacancies during the Great Recession, or prior to the Great Recession, it had very little to do with oversupply. It was really driven by a move towards home ownership. And that was a big factor also in the decreasing vacancy rates in apartments post-Great Recession. It was that move away from homeownership back to rentals. So keep in mind that Portland has, right around 800,000 households. So you see a 1% homeownership shift. That's 8,000 households that are no longer potential renters. I'm not saying that they all left the rental market, because a lot of them were not in the rental market. But once you get in that house, odds are you're not going to go back to the apartment anytime soon. And in recent years, Portland has seen demand for new apartments between 4,000 and 7,000 units per year. So it's pretty easy to see how a shifting home ownership ratio can pull a lot of that demand. It can offset a lot of that strong absorption that we've had. Due to COVID, year to date has seen a shift towards home ownership, especially from renters in the most expensive units. Portland is undersupplied with affordable homes, so there's only a limit on how far that home ownership ratio can swing. For the past 10 years, there's been this talk of millennials driving apartment development, and I don't doubt that at all. But also keep in mind that the oldest millennials are now 40 years old. And the idea that this cohort will be lifetime renters, it's lost a lot of steam. I think they were more a product of their economic conditions and didn't necessarily want to be, renters for life. So this graph shows how demographics will shift, in the next 10 years. And more or less it's showing, you can read through it later, but it shows how, the groups that trend towards an urban lifestyle with the 20 to 30-year-olds and the empty nesters is shrinking considerably. Those are the boxes in red. And then the groups that shift, more towards a suburban lifestyle with the 30 to 50-year-olds and the 65 plus, that's a population group that's growing considerably. This is national numbers. But the same thing's happening in Portland. The light blue line is the number of 30 to 34-year-olds, and dark blue is 40 to 44. And basically what this is saying is in 5 years from now, the number of people between age 30 and 34, which is the peak for first-time home buyers, is going to grow by 50,000 people. And the number of 40 to 44-year-olds in 10 years, that group is going to grow by 75,000. And 40 to 44 is your peak housing expenditure years. So this is labeled, housing's 2020 demand tailwind. But for apartments, it's a headwind, because these are all potential renters that could be moving into a home ownership phase of their life. I think the biggest surprise in this recession has been the interest rates. It's the first time ever that the 30-year mortgage has dropped below 3%, and we blew by that. I mean, we're down 220 basis points from December of 2018, and we're down 90 basis points since March. There's been an extraordinary effort to keep rates low. And this is what has kept, me busy. It's kept the banks busy. It's kept mortgage brokers, real estate brokers, owners, buyers, title companies, sellers, developers, construction companies, subs. You can all point back to these low interest rates, which is really what's driving this economy right now. And I care about interest rates for two reasons. Not only does it kickstart economic activity, but it also has an impact on cap rates. This spread will vary, but in general, when interest rates go down, cap rates also go down and values go up. The spread can vary. This chart, it shows it varying from 430 to 100 basis points. But in general, these two figures move in the same direction. There's been a drastic drop recently, and I can't say that cap rates have dropped by that much, but there has been some change. So, and then with construction, we hit rock bottom in 2009 when we had permits issued for just over 1,000 units, but we've remained above 5,000 units per year since 2013. In 2019, there was permit applications for about 8,800 new units. Year-to-date figures, we're in the neighborhood of annualized will be around 5,800 new units. And this is a 35% drop from the past 3 years average. But we have added 40,000 new units in 5 years, which represents 20% increase in our apartment inventory. And that's a really big increase. And CoStar reports that we currently have that we currently have 6,700 units under construction. Construction starts are down for sure. A lot of developers that were planning on doing something in early to mid 2020 maybe took a pause, reconsidered. As an appraiser, I really look at supply in the short term. How is it going to impact the property that I'm appraising when it comes to market? Is it going to be oversupply, undersupply? Economists take a much bigger view. So they're actually saying that for the past 10 years, we have been an all-time low in terms of new construction per residence. And this is, both multifamily and single family. And just to give you kind of an idea, in the 1970s, we had 2 years where permits were over 8,000 units. You can see 8,000 units is a lot. But that was at a time when our population in the metro area was 1.1 million. So we just hit 10,000 units. It took us 40 years to break 8,000. We finally hit 10,000. But our population is now 2.4 million. So while the numbers are strong, it's not as strong as if you look at it relative to population growth.
Patrick, real quick.
Yeah.
Do you get your permit data from CoStar? Is that where you said you get it from?
No, the permit data is actually from the Census Bureau.
Okay.
They publish monthly permit applications for every county in the entire U.S.
Okay.
It's for single family. They break it down from single family, 2 to 3, 4 units, and then 5+.
Got it.
So
cool.
You can look all that information up.
Thank you.
Yeah. So while for current owners, a lack of new supply helps you because it, pushes down your vacancy and up your rents and increases your value. As a metro area, we really do want to flood the market with new units because it keeps those costs down. And when employers are considering, where to potentially locate that new hub or where to move the office, a lot of times they want affordability. And they want to know that their employees can rent an affordable apartment or they can buy a house if they want. And if we get to a point where we're just not affordable anymore, while it's a great benefit for you right now, it's not great long term. So I want to move into some apartment fundamentals. COVID has upended a lot of trends that we've become accustomed to in the past decade. And right now it's a challenge to predict whether those changes are temporary, are they permanent, or is it somewhere in between. And we do have this urban-suburban divide a little bit. Due to COVID, there has been some shifting tenant preferences. CBRE came out with they had a year-end report recently, and they said 5 major COVID-related factors diminished the appeal of urban submarkets in 2020. Remote working requirements, the closing of a portion of urban amenities, the reluctance to use public transit, a desire for more living space, and the desire for greater access to the outdoors. Portland, you can throw in that civil unrest too, as a 6th factor. And to top it all off, rents are cheaper in the suburban area. So pre-COVID, vacancies were generally in that 4 to 5% range. There's always been some variation on vacancies based on when the new units are counted. Do you count the new units, the second they finish? Do you give them a year? Do you give them 2 years? Do you start counting on once it stabilizes, no matter how long it takes? And there's also been a ban on evictions, which just today got extended through June 30th. So there's a lot of different opinions about the vacancy rate, but Kidder Matthews has it at 6.5, Multifamily Northwest has it at 5.0, Collier 7.3, Marcus and Millichap 4.4. So generally, let's call it between maybe 5.5 and 6.5, or maybe 5 and 6. So CoStar reports vacancies are 7.0, but this includes units in lease up. And they're actually forecasting that new units are going to hit 13% vacancy, while older units are going to remain fairly stable. The older units are the orange line on this chart here, that they'll cross just over 6% before coming back down. However, you can break this down a little further, and this is actually just stabilized. So they take out the new units, and you can see the stabilized vacancy, is forecast to reach about 6.4, which is a much easier to digest figure than the previous slide, where they had overall vacancies, approaching 8%. So this graph has a lot going on. and I wouldn't put it up here unless I thought it was really important. So the orange bars represent demand or absorption. The blue bars represent supply, and the green line represents Portland vacancy rate. So you can see that, we actually had surprisingly strong demand in 2020, but throughout 2021, CoStar is forecasting that supply will outpace demand, and it will not, drop below until 2022, and that's what's going to force up the vacancy rate across Portland Metro. But also, I take it with a grain of salt because CoStar, they also forecast that absorption would be far less than supply for all of 2020, and that clearly has not happened. So, a lot of tenants are rethinking their housing needs. This is on a national level. This shows new demand in, on the top is suburban and the lower one's downtowns or urban areas. And you can see that, the suburbs had missing demand, so lower demand of 11,600 units in the spring. But then when they get to the summer, they had excess demand that they don't typically see, close to 80,000 new units. So the gray bars are average and the orange columns is actual demand. So you can see, suburban demand far exceeded historicals. And then you move to the urban area, and which is the opposite. We had missing demand throughout the spring and summer and fall of about 55,000 units. And they finally exceeded their average in November, absorbing about 4,400 units. And Portland saw really similar. This is not broken down by suburban or urban. But in the spring, we were below average demand of about 750 units. And then we moved to the summer and fall, and we actually had excess demand of about 1,100 units. This is showing vacancy rates is what's happened nationally. You can see that urban areas are at about 6.9%, and the average suburban area is 5.8%. So here I want to start talking about rent a little bit, and keep in mind I'm talking about rent and not income. There's a big distinction that you should make. For my year-to-date appraisals, I'm seeing rents that are mostly flat or down slightly in year-to-date, more so with the urban units, less so with suburban units. I think property owners at this point, if they can just keep their tenant in place and keep them paying, they don't give a rip about a rent increase right now. They just want to keep the units occupied and keep everybody paying. Portland Metro, rents were more or less flat in 2020, and they're actually forecast to stay flat in 2021 as well. But once you get beyond 2021, they're forecasting pretty aggressive rent increases, somewhere in that 4 to 5% range. In the suburban-urban divide, it's not just Portland Metro. This is the change in rent nationwide. On the left is the markets with the highest rent growth, and 17 of the 20 are suburban markets. And then the markets with the biggest rent losses, you can see 18 of the 20 are urban markets. And this is actually Portland one-bedroom units, and you can see that overall they're down about 1%, but the suburban area is up, maybe 2%, and the urban area is down about 5%. And also the change in rent. I mean, the biggest change in rent in Portland Metro has been Wilsonville, Clackamas County, Vancouver, Oregon City. And the biggest loss in rent has been downtown, Northwest, Southeast, Southwest, all urban areas, all really high rates of construction. So concessions are back, in particular new units, and the concessions are pretty aggressive. These developers are racing to fill these buildings up as fast as they can so they can get to stabilization and get off their construction loan. And there's also a heck of a lot of units coming online, this winter and spring. And if they can't stabilize now, that's just more competition to deal with in a few months. So this is one over in Southeast Portland. They're giving away 8 weeks free plus $1,000. This is in Goose Hollow. They're giving away 8 weeks. This is out in Beaverton, and they're giving away 2 to 3 weeks of free rent. This is out in Gresham. They're giving away 4 weeks. And then this is one up in Vancouver where they're giving 4 weeks. So income is a really hot topic right now. And every appraisal I do, the lender wants to know exactly how much is delinquent, what units are delinquent, how many months, are they on a payment plan, just kind of what the story is. And oftentimes we get the rent roll, and the rent roll looks great. I mean, everyone's got a high scheduled rent. And then you ask about collections, and it's a whole different story. And the eviction moratorium is really tied up owners' hands, and there's nothing that they can do right now. You know, in the appraisal I've done for year-to-date 2020, income is generally flat on the year, some up 1 to 2%, some down 1 to 2%. I think a lot of these owners, they're under no illusion that they're ever going to collect any of these missed rental payments. Oregon's considering legislation right now that would create a fund where owners can collect up to 80% of missed rent, with the understanding that you can no longer evict these tenants. But I'll get more into that later. So since COVID started, you know, I've only appraised one property that's had really poor collections, and they had a rent strike, and there was 6 tenants out of 12 that were not paying. So that's the hardest. That's really the only, you know, substantial losses I've seen. I've spoken to 5 or 7 property management companies or large owners leading up to this presentation, and most were reporting collections somewhere in the range of 85 to 95%. This is a survey from the National Multifamily Housing Council. You can see that collections in 2009, they ranged from maybe 95 to 96%. As you get to 2020, you know, we started off at 95, then we're trending towards 94. November was 93. So this does make me a little nervous. I really hope at the national level that there's some kind of federal help to get these numbers back up, because this is fairly concerning. So moving on to expenses. Typically, there's not too much to say here. We have property taxes. We saw more or less a standard 3% increase this past year, but there's a big increase coming in 2021. We still have gross inequities in our tax system. These are 2 properties that sold in September of 2019. Both of them sold for $200,000 a unit. You know, the property on the left has taxes of around $1,400 per unit, and the property on the right has taxes of $2,500 per unit. You figure on a per unit basis, they're the exact same value. So, you know, we had most of the ballot measures passed, and this will definitely impact taxes coming up. Repair and maintenance has stayed fairly stable. The only complaint I've heard is that supply issues with, especially properties that are under construction or where there's major renovations occurring, that they're having trouble, especially with appliances. It seems like appliances and flooring are the 2 biggest complaints I hear. There was one company I talked to that now subs out all their maintenance work because there was some fear of liability there. In management, we have seen a trend towards self-showing units where you go and enter a key code and you can show it yourself. We've seen, you know, the live FaceTime showings. We've seen pre-recorded walkthroughs. So I think that this was gaining momentum, but it's definitely picking up speed with COVID.
Patrick, do you know what year these properties were built by chance?
I think one was 1920s, the one in Northwest Portland, and I think it was 1970s for the close and southeast one.
Okay.
But it was all based on the tax measures that went into place in 94, 95,
Right.
that reset, you know, all the assessed values. In terms of admin costs, just dealing with these new regulations, I have not seen an increase in admin costs yet, but I have to imagine that it's coming at some point. You know, insurance is fairly stable, and utilities, we've seen some rate increases, but nothing, you know, nothing out of the ordinary. The big thing that I want to talk about today that we usually don't talk about, usually if we talk about taxes, it's always above the line. It's always property taxes. We don't care about income taxes. That's just not what we deal with on the appraisal side. And recently, you know, Bluestone and Hockley, Cliff Hockley, Moss Adams, and CKR Law Group, you know, they sponsored a seminar about the new business and individual taxes that are going into effect soon. Given the credibility of these participants, you know, I don't feel this is an over-exaggeration, But I did talk to Cliff Hockley today, and he wanted me to clarify that this is not accounting or legal advice, that you should consult your CPA or your attorney to really see how this impacts you. But to put it bluntly, I was floored by this analysis. I can provide the link to anyone. I can provide it to Trent after this to send out to your group. But first, in this article, they had a table, quick summary about what the taxes in place are, what jurisdiction it impacts, who it impacts, and then how much it is on the marginal rate. But they went through just an example here, and keep in mind this affects a very small portion of people, but it is going to impact a lot of apartment owners. And in their hypothetical here, it is a company, a business that has a gross income of $5 million. The owners net $400,000, and they also have an apartment building that nets $100,000 a year. Keeping everything constant. This analysis considers the taxes, state and local taxes, that they would have paid in 2019, 2020, and 2021. And you can see on the bottom here, in 2019, based on this same scenario with no changes, their taxes would have been $155,000. You move to their taxes in 2020, and you're looking at taxes of $189,000. And you move to 2021, based on all the taxes that went into place with the preschool tax, the homeless tax they just added, you'd be paying taxes of $214,000 in the city of Portland. So this is a 38% increase in taxes from 2019 to 2021. And again, this is very high net worth or high income individuals. So it's only going to apply to a small number of people, but this is still a drastic increase in tax liability at the state and local level. And from people I've talked to, I just feel no one's done the math on this. No one's really aware of how these taxes are going to impact you. And it's not even going to be until, early to mid 2022 that people come to realize this. The second example is a property that was sold for $4 million with gains of $2 million. And this is just an example of what taxes you'd be responsible for in Portland, Beaverton, and Bend. So again, not changing anything. The Portland taxes on this sale would be $392,000. In Beaverton, it'd be about $245,000. And in Bend, you'd be looking at taxes of $221,000. So I just find it hard to imagine that at some point down the road, I feel this has to impact investment. And I'm just not sure that owners and investors are just aware of these taxes yet, but we'll see how it plays out. So if you've seen me present before, you've probably seen this graph, but I use this every time. This is showing income growth in blue and rent growth in orange. And for years, these two figures, they were tracking along very nicely as they should. And then we entered this period of 2014, 2017, when we had this disconnect between wage growth and rent growth. And what followed, was a wave of regulation. And if you can believe it, we entered a housing emergency from the City Council, Portland, in October of 2015. And here we are in December of 2020, and we still remain, in that quote unquote housing emergency. So from this period, that's when we got, a lot of the value add people, where they go in and they buy the property, they issue, at that time it was a 30-day notice for eviction, no cause, no penalty, and everybody would be out. They upgrade the units all at one time, very efficient, bring the property back to market and sell it for a huge profit. There was a lot of people during this time, and following this period, we saw rent control, we saw inclusionary zoning, we saw relocation costs, screening criteria, and security deposit regulation. A lot of other small ones that, I won't even get into here. And so here, today we, have an effective ban on rent increases in the city of Portland. We have an eviction moratorium. Just yesterday, there was a proposal at the state level that would extend it through June 30th, but also create a fund for people who've lost rent, owners who have lost rent, to apply for it. And you can claim back 80% of that lost rent. Just today, Portland extended the housing or the eviction moratorium through June 30th. They did this ahead of the state. So now, no matter what the state does, Portland still has its housing emergency. And multifamily housing count, multifamily Northwest came out against the state rules. But given that Portland's already done it, it's going to happen in Portland no matter what. And I think at the state level, you probably do want it to pass, so you can at least try and claim back that rent, because Portland has no way of claiming back, any rent. But there is a big shift occurring in the city council. There's 3 new members this year. Supposedly they're more business friendly, but time will tell. And this is pushing people out of the city of Portland, or Oregon in general. I've spoken to at least 5 owners in this year, and they're planning on either liquidating their assets now, they've already liquidated them, they're in the process of doing it, or they plan to sometime soon. So, and I think this will continue. I think a lot of people are just fed up. They're just sick of being in, especially the city of Portland. From an investment standpoint, they can deal with rent control. Other states have it. We can figure out how to deal with that. The issue is just not knowing what's coming next. And City of Portland's been so erratic in terms of the regulation. I think the scary thing is just not knowing what's coming down the pipeline next. So, my concern is that Portland had a great run from 2013 to 2018. City of Portland felt that we were invincible. Oregon felt that we were invincible, and that people would come here no matter what. We had huge population gains, huge job gains, but a rising tide lifts all boats. And our market continues to rely heavily on outside investment, and Portland and Oregon seem to be giving everybody reasons, for them to look elsewhere. Between the new taxes, the civil unrest, I could go on and on. But I felt this was reflected in ULI when they came out in November with their rankings for 2021. Overall real estate prospects, Portland ranked number 20 out of the top 80 metros. We ranked number 20 last year. For this year ahead, we moved down to 66. And in terms of there was a survey based on local participants. We ranked number 1 for development and redevelopment opportunities. And this year, we fell to 63. That's a big fall from 1 to 63, just over the course of 1 year. So again, the biggest issue, I think, is just this perception of risk, uncertainty, and just not knowing what else is coming down the pipeline. So this is part of the reason why everybody's here, is to hear about what's happening in the sales market. And the most common question I get, is what's happening with sales. And really, there's 2 ways to look at it. We look at number of transactions and then dollar volume. 2019 was a great year. We had 220 sales. Through November, Portland Metro, there's been 128 sales. So annualized, that brings us to about 140, which is a big drop, but I can't say it's that surprising. Since 2011, we haven't dropped below 150, and this will be the first time in 10 years, that we've dropped below 150 transactions per year. Sales volume in 2019, we passed the 2 billion mark. Today, we sit at about 1.25 billion, on track for 1.36 billion. So it's definitely a big slowdown. And this is how 140 sales looks compared to the past, 13 years. So you can see we're going to be in that neighborhood of 2010, 2011 time. It's not unprecedented. We've been here before, so I think we'll get through it. So what's happening in terms of values? If I would have done this presentation in April or May, I probably would have made everybody run for the hills, because I would have thought, there's no way that values can hold up through the recession that's going to be coming. And I think CoStar even had us forecast at down maybe 15 to 20% in value by the end of the year. So 2019 values are basically flat from 2018, but then we get to 2020, and per unit values are up 16%. And this represents the median price with all 128 sales throughout, Multnomah, Clackamas, Washington, and Clark County. And if you move to the median price per square foot, we're up 14%. So it's pretty consistent. 16% on per unit, 14% on per square foot. So I'm going to go out on a limb here, and I'm going to say that I think the makeup of properties sold in year to date, I think this overstates the actual increases because of a few trends. Given all the uncertainty out there, sales have trended towards new properties in good condition. They've trended towards properties that are in safe, stable locations. They've transitioned towards turnkey properties that are operating with rents at market without considerable deferred maintenance. There's also trended towards larger units, just given the nature of COVID. But it's important to note what's not been selling in 2020 and just how that's impacted the median price. So what's not been selling? Value add properties that require major capital improvements or that require extensive evictions. Properties in less stable locations with a population that's dependent on service/retail type jobs. What's not selling is properties that have been struggling collections or rent well below market due to financing concerns and just an inability to raise rents right now. And there's a lot of investors that have been hesitant to invest in properties with an emphasis on really small units. Again, given COVID, we're trending away from this. So more or less 2020 to me represents a flight to quality. And I think we've seen that in the sales. A few other trends I want to note is, so from January to March, we averaged 15.3 sales per month. We hit April to July, we averaged 8.5. Then we picked up, in August, and now we're averaging about 12 a month. And the other thing is the sales east of 205, which, is a little bit rougher area, lower income, traditionally higher unemployment. From January to March, there was 11 sales east of 205, 3.7 per month. And then we get to April to November, and there's been 7 total sales east of 205, which puts us at about 0.9 per month. Another major contributor to the value increases is just the incredibly low cap rate and the search for yield. That's the same reason the stock market's been overrun. When you have a 10-year treasury at 0.9%, buyers are willing to accept lower returns as there's no alternative. And when I say accept lower returns, what I'm inferring is that they're willing to pay a higher price for the same income at the end of the day. So the other major contributor is that the other real estate types that have been longtime favorites of investors, retail, office, hospitality, I think most investors wouldn't even consider those right now. So apartments and industrial, no question that they benefited from additional investments. But when these industries bounce back, it will give investors more alternatives. I think there will be some shifting investments. So I just want to cover a few specific market segments here. This was 1960. This is what's happened with prices from 1960 to 1990. Suburban. This was kind of the bread and butter. This was during the heydays of constructions in the 60s and 70s. This is where it was, suburban. We've seen consistent increases, relatively stable values. But there's only been 30 sales through year-to-date 2020, which is down about 50% from last year. And you figure that overall sales were down 36%. So this is definitely outsized decline in sales. Move on to new apartments. We saw a big run up as the first wave of units were completed. This market's been flat more or less since 2015, 2016, mainly because there's a lot of merchant builders out there that have no intention of holding these properties. They need to build them, they need to stabilize them, and they need to sell them so they can move on to the next project. And this is really what's kept prices in check. Year to date is up, and this reflects a larger average unit size that's being sold, which explains the price per unit is up, but the median price per square foot is down. Sales are down about 30%. Oh, I'm sorry. Sales are actually competitive with last year. So overall sales are down 36%. Sales in new buildings are actually up. So there's been considerable interest in the new buildings.
Hey, Patrick, do you have any opinions on why value add properties are not selling?
Because you can't raise rents and you can't evict anyone. And that's pretty essential right now to, adding value to the property. So,
Yeah.
Most of the times, unless there's a really steep discount, buyers just don't, they don't want to risk it because this eviction moratorium just keeps getting pushed out and out and out. And right now we sit at June 30th, but June 29th, who knows? It may get kicked out another 6 months. So I just think it's really risky right now to get into a deep value add type deal.
And that kind of goes back to what you were talking about with the unknown that we're experiencing and the ever changing rules and regulations and stuff that we have to abide by, right?
Yeah, no, and every investor is just really hesitant to get in these type of deals right now. And just the political environment. I mean, it's so hard to go into. There's been some horror stories about people who've gone in and they've tried to do it right. There's been a property that's been neglected, and they go in and they try and upgrade units, but it requires evicting tenants, and you can't have both. You can't have low rents and nice units. They kind of go together. So
yeah.
So this represents sale trends for pre-1950 built apartments. This remains an attractive market, and again, values have been mostly stable in recent years. Similar transactions to 2019, so this has been, a fairly active market. This is sales of 1960 to 1990 City of Portland urban units. It seems like with the value add deals, this is what everybody wants. They want the bigger units, on-site parking, and just a few more creature comforts. Some washer dryer hookups, you got dishwashers, and this is way down. This is down 56% from last year. So this has been a really slow market. You move to Clark County, which has definitely benefited from some of the regulation in Oregon. Values have been fairly steady, increasing. This is 5 to 20 units. This is typically a very, very active market, and transactions are down 52% this year. So this has been a market that's been really, really impacted, but values are at record highs. And then this is East County. We've seen very little change in value since 2017, 2018, and transactions are down 62% east of I-205. So I just pulled a few sales just to kind of show you guys what's been selling in the past few months. This is an 8-unit apartment close to Northeast Portland. It just sold for $250,000 a unit. This was a value add deal in Beaverton. It was purchased for around $158 a unit in April of 2018 and just sold in May for $200,000 a unit. This is an American property management property, Joe Weston, and it just sold for $129,000 a unit over in Southwest Portland off Beaverton Hillsdale Highway. This is a 13-unit out in East County, and it just sold for $109,000 a unit. And then lastly, this is a small property over in Tualatin, big units, and it just sold for $188,000 a unit. So if I had to give some forecast for 2020, there's a ton of uncertainty. I'm not smart enough to forecast this stuff, so I relied on a lot of the big companies with endless data points to assist me in this. This is the forecast from CBRE. They're forecasting that we recover full employment by mid-2023. This is from the Oregon Office of Economic Analysis. They have really similar forecasts, and they have us recovering also by the mid-2023. In July, they've revised it and actually moved the recovery forward a year, so we improved from their first forecast. CoStar has a recovery of jobs by late 2022 to early 2023. And the slower job growth that we're going to experience is going to impact population growth. There's no question about it. And in turn, the slower population growth is going to impact demand. So here, this is units currently under construction. We sit at about 6,700 right now, and we're trending down. And I can't imagine we're going any higher next year. So I think we're going to be down considerably next year and moving into 2022. Absorption was unusually strong in 2021. I think this caught everyone off guard. But again, take this with a grain of salt. They're forecasting really low demand for the year ahead. But they also had really low forecasts back in April and May for 2020. So I'm hoping that we see higher demand than what they're forecasting here. But I think we should be prepared for lower demand, especially a lot of these new units. I think we're going to see high vacancies, extended lease-up periods. Actually, just got a call from a lender a couple of days ago, and they wanted a survey of absorption rates across Portland Metro because they have a project. I think it's been open for 8 months, and they're still at 30% occupancy. So they were pretty concerned about this and calling me. So overall vacancy, CoStar thinks that we're going to hit about 7.75% overall for Portland. You take out the new units, and they think we're going to peak out at about 6.35. Again, this is something that we can live with. We've been here before. 6.35 is not horrible in the grand scheme of things. They're forecasting rents are flat throughout 2021, and then beyond 2021, we'd make up some ground, and they see us increasing at maybe 4 to 5% in 2022 and 2023. So don't ask me how they do it. I know there's a ton of data points behind this. I know there's full-time economists working for CoStar with information from Oxford Economics, but they're basically saying that by the end of 2021, that we're going to be at a similar values to where we are today. And then beyond 2021, they actually have pretty aggressive value increases in here, rivaling where we were back in 2015 and 2016. So take it with a grain of salt. I don't know how they forecast value increases, but this is what their thoughts are. And actually, just before this meeting, I pulled the data. Most owners, especially portfolio owners, they've had a pretty darn good 2020, all things considered. And a lot of these owners have gone through and taken advantage of these great rates, and they've built up what I consider a war chest, so that if there is distress and if there is blood on the streets, that they are going to be ready to pounce on these deals. I looked it up, and there's been 128 sales for year-to-date 2020. CoStar allows you to go in and look at how many new loans have originated. So anything that's not a sale, in terms of a new loan, I would consider that to be a refinance. And there's been 600 refinances, or 600 new loans. So take out the 128, and what's left is how many individuals have refinanced their properties this year. And I'm sure a lot of them took advantage of low rates and increasing values. And I would have to imagine that there's a lot of owners out there that have a big pot of cash that will be looking for deals coming up in the next year or two. So in terms of, my biggest concern moving forward is if the government just can't settle on some kind of federal assistance. And it brings up this potential for mass evictions. Portland Metro would be impacted too. Just today, this afternoon, that got kicked down the road till at least June 30th. But they're going to have to come up with something to help owners, because there's a ton of tenants that will be facing eviction, as soon as the eviction moratorium ends. So Oregon's going to have to deal with it sometime. They can't just keep kicking this can down the road. I'm also concerned about a trend towards homeownership. This is going to hurt apartment demand, especially at the newer units, which rely on that 20 to 40-year-olds who want to live in the urban area at the new fancy, shiny apartment. I'm very concerned about properties that are coming online this winter and trying to stabilize with lower demand, increasing concessions, lower rents. And there's already a ton of vacant units right now at the new properties, and there's more coming online. So if there was one major concern, that's probably what I'm most concerned about. And then lastly, is just the unpredictability of not only the virus, but then the regulatory response to the virus. But what I'm optimistic about is, I know I'm biased, but I still think that Portland remains an attractive location, not only for investors, but for jobs. And I think the population can grow. At the start of this pandemic, there was a lot of doom and gloom on rents, values, absorption, vacancy, and it's all been much better than forecast. So I'm optimistic about that. We still remain an affordable city on the West Coast. And then there's, strong suggestion that most metrics are going to recover by 2022 at the latest. So, and then, so far there's been really no real distress. I know of only one or two distress sales And these were developers. I don't know if they got hard money loans or just what the deal was, but they had to get out of their properties quick, and they were willing to accept, you know, a lower price. But there's just not been the blood in the streets like we saw in 2008, 2009, 2010. So, you know, I can send it out to Trent or whoever, but this is a table from CBRE that, you know, it's their take on the challenges that multifamily faces and what that path to recovery, you know, in 2021 looks like. And if you haven't had a chance to read it, it's a great, thoughtful piece, and I highly recommend it. So, anyway, Trent, I'm happy to take some questions if there are some, and I can send you the information, you know, the tax study and the slides and stuff later. So.
Awesome, Patrick. Thank you very much. I'm definitely interested in all of the information that you've had to provide. So thank you.
I will second what Jacob just said. I would definitely appreciate any information that you're willing to share. I don't know if it's just me, but I kind of like want to move out of Oregon now.
Well,
I love it here.
I do too.
there's a lot of, I mean, there's a lot of positives going on. I'm just a little nervous about unintended consequences from this regulation and taxes. And, you know, about 75% of our investment in multifamily comes from out of the state of Oregon in terms of dollar volume. So, I mean, we rely heavily on outside investment, and this outside investment, it has no ties to Portland. It has no loyalty to Portland. It has no loyalty to Oregon. You know, it's just chasing return. And if that return is better in Idaho or Utah or Seattle or wherever, Texas, I mean, it's going to go there. There's nothing keeping it here in Portland. So,
and I mean, based on the numbers that I saw, if I was an out-of-state investor, strictly looking at numbers like Kenzie was talking about earlier, it looks like the numbers might be getting closer to the point where I wouldn't want to put my money there anymore.
No, I think it's going to be a challenge coming up, especially city of Portland.
Yeah. That slide that you had on taxes was really interesting. Just
on video too.
The increase in taxes over a 2-year period that's a pretty significant jump.
Yeah, I mean, those are big income numbers too. So it's going to impact a very small slice of the group, but I mean, that's the slice that, you know, they're the ones who motivate the developers to build the 100-unit apartments. So
exactly. Yeah. Are there any other questions that we have? I was monitoring the Q&A in the chat box. I did see a question a little bit ago, and I think you touched on it. It sounds like rents overall are going down, especially for the urban areas, and then suburban areas are a little bit more stable.
Yeah, in general, I've seen rents flat or slight increases in the suburbs. No question, I've seen rents, you know, down in the urban area, especially when you get to the modest studios, in the older buildings that are really high density, or even the highly amenitized new buildings. I think people just don't want to pay that premium for the shared spaces right now. I mean, they're paying for parking, they're paying for utilities. They can move out to the suburbs and get, you know, 30% more space for the same price. And if they're not even going into the office, it doesn't really matter. So.
And if there's nothing open to go enjoy downtown.
Yeah, and all the urban amenities just don't exist downtown right now. So.
Yeah.
I mean, I think it's temporary. I think it's going to swing to the suburbs. I think there will be a swing back. I'm not sure if we'll get all the way back to where it was. So.
Hey, Patrick, Chris Shepard here. I'd love to chat more about the foreign investment, and then just kind of like, especially in Portland, the downtown CBD has just been crushed.
Yeah.
You know, multifamily the least, but you know, commercial and retail. So what are your thoughts on like this exodus? Like there's a renter exodus, but as well, I also feel like what are your thoughts on the investors exiting the downtown area too?
Yeah, it's so hard that I just don't work in institutional type market. I don't really touch anything much above, maybe 150 units or 100 units. So I find it really hard to judge what institutional investors are doing, but there continues to be sales of large, institutional grade urban properties. I think a lot of these investment firms, they're not looking at a 1 or 2 year horizon. They're looking at a 10 to 20 year horizon. So they see a bigger picture than we do. I mean, if you went downtown right now, there's no chance you would invest. But they're looking to place large sums of money. They have to place it somewhere. And they're looking at a 10-year return. So I think if they can come in and get maybe a slight discount right now, to them it's worth it. And in terms of international investments, that's just not a market that I'm familiar with.
Yeah. We've got a question from Chris Schwint. He's asking about mixed use and the commercial vacancies in those properties. How does that affect values?
I know a lot of lenders right now that don't even that will assign basically no value to the mixed use portion of it, just because it's so risky right now that when they do their underwriting, they're really not even taking the mixed use into consideration right now. Unless you're being forced to, there's just not a whole lot of people who are choosing to do mixed use. There's some zoning that requires ground floor to be retail if you want to build multifamily above, and those are the only people right now I hear who are choosing to do mixed use, because you go up and down those main streets and I mean, there's for rent signs, or there's the for lease signs everywhere. So it's a really, really tough market right now. And not many people, I mean, unless you already have the units, unless you're already building it, no one's building mixed use. I mean, there was even some units a few years ago where they took the ground floor retail and converted it into residential units because there was just simply no demand for it.
Wow. So, I guess, in the 2015, 2016, 2017 areas like Mississippi and Clinton just completely exploded. And those were some of the most popular areas in town. Yeah. And that was something that I always saw would be, an emerging trend. And one of the things that made Portland so desirable to live in. And I guess my question is like that, is that idea or those like close in neighborhoods being phased out? It sounds like, investment is being shifted away from those areas.
Yeah, I think it's going to come back. I didn't cover the quote here, but let's see if I can find it. CBRE came out, and I consider them to be a heck of a lot smarter than me. They came out and said there are no indications that the 2020s decline in urban multifamily demand is permanent, or there is an impending return to the hollowed out cities of the 1970s and 1980s. So I don't think we're returning to, no demand or, like they said, the hollowed out cities. I think there's going to be, I don't think we're going to go all the way back to where we were 2 years ago. But I just don't see the urban area dying out right now. I mean, I think it's hard to see past, it's hard to see post-pandemic right now. So I think that might cloud some of our judgment. But it's not going to be, a V return to
yeah.
It's going to be a slow return. So,
Chad, are there any other questions?
Yep. From Cheryl, out in the Beaverton area, would you suggest building single-family homes on small lots or building apartments?
Even though I appraise residential, I don't touch single-family homes, so I can't comment on single-family homes versus apartments out there. I know that small apartment buildings are in high demand right now. There's a heck of a lot of buyers out there that can afford the 3 to 10 unit apartment buildings right now. and those seem to get snatched up for extremely high prices that I'm not even sure I can justify as an appraiser. So I know that there's really high demand for small rental property right now. There's just a lot of people out there who have, you know, $100,000 to $500,000 to invest in small multifamily deals right now.
And it kind of sounds like if you stay into that 3 to 10 unit realm, you should be able to rent it out and get financing and stuff like that for it as well.
There's a lot of people out there looking to finance. Well, I guess 5 and above. There's a lot of players in that market, but it is more challenging though. A lot of the bigger lenders don't really want to go under certain loan amounts, so finding lenders to fill in those gaps actually is a bit of a challenge. But there's plenty of credit unions and smaller banks out there that would be happy to loan on a 5, 6, 7 unit deal.
Cool. I don't see any more questions, so and if you do have a question, feel free to throw it down in the question box. Patrick, thank you so much for your presentation. Do you have anything else you want to wrap?
If people want to call and chat with me, if they have questions, you can email me, you can call me. I'm always happy to talk with you. So I think you guys have my contact information, or it was presented somewhere. So feel free to reach out, even if you have, appraisal related questions about why we do it certain ways, or I can send sales or rents or whatever you want. I'm always happy to help.
Yep. And like Patrick said, we do have his contact information. So if you do have questions for him, feel free to reach out to us, and we're happy to share that. Terry, do you have anything else before we head out?
I don't, other than this was a lot of information for me, Patrick. Good information on apartments that I'm not really, I do a lot of residential. I don't know a lot about apartments. So it was great information. Thank you for sharing. I know there's a lot of realtors on here as well that were just kind of interested. They may have clients that are interested in buying apartments. So this is good information for them as well. So thank you so much for coming. All of you that are on, that are realtors, you should be getting your certificate, your class certificate within the next 72 hours. So certainly reach out to me if you don't receive it, and we'll make sure you get that. So thanks again, Uptown Properties, for all that you do. And I hope everybody has happy holidays.
Awesome. Thank you very much, Terry. And thank you, Patrick.
Yeah,
You're
thanks for the opportunity. I appreciate it.
Thank you, everybody. Thanks,
Bye.
Patrick.
Bye, Chris.
Holidays.
Bye.
Bye.
Bye, Jacob, Trent, everyone.